Hey everyone, glad to be with you today. We'll go over a Q4 2022 market recap for about 15 minutes. Adam's going to take us through that. And then the ever anticipated topic of, is Social Security going broke? That'll be the majority of our presentation today. We'll go through, is the trust fund going broke? We'll go through, is there anything we can do about it? And stand by to figure out what we can do. So, as I said, without further ado, we'll have Adam take us through kind of a little bit of an annual market review, maybe even more of a quarter market review, and then we'll go from there. So, Adam.
Absolutely. Yeah. So, this is our overall market summary that you're going to see up on the screen. This kind of shows how different markets have been performing across U.S., international, emerging markets, real estate, and the bond market in the U.S. And it probably comes as no surprise to a lot of you if you've been seeing the news. Overall markets have been down this past year. They're not down to a level near like 2008 at the end of the year, or even early 2000s necessarily, but they are down significantly on the year. An important distinction to say here is this is not necessarily the exact portfolio we invest in, but our portfolios and any portfolios are impacted to a large extent by what's going on in the broader market. Some recap here. U.S. down close to 20% over last year, the U.S. stock market. International actually fared a little bit better, down only about 14% on the year. Emerging markets pretty close to where U.S. was, down about 20%. Real estate down even more than that, which kind of makes sense with some of the interest rate dynamics. And then the bond market was down quite a bit too, which a lot of times in the past when stocks have gone down, bonds have actually gone up. So that was, I think, a surprise for a lot of investors this year. Of they don't always move in opposite directions. Sometimes bonds go down at the same time as the stocks.
Yeah, I agree. And maybe not digging in too far on your very first slide, but I think that is a question that a lot of folks that will be watching this ask is, hey, in the past when my stock's been down, my bonds have been up. Why are they both down now? So do you want to briefly go into that?
Yeah, absolutely. So, a lot of times what happens when stocks are going down is, we're having a lot of economic difficulties. Like in 2008, there was kind of a banking crisis that people were afraid would spread throughout the whole economy. A couple of years ago, we had obviously, COVID and all the economic turbulence that surrounded that. And the Federal Reserve, which is kind of the branch of government that controls interest rates, usually responds to economic turbulence or crises by cutting interest rates. And the reason they do that is the lower the interest rates are, the more people can borrow and buy stuff. And so it's sort of a way to combat the economy going through tough times is telling everybody, hey, you have access to cheap loans. And so, don't worry too much about stuff, go buy stuff. We're kind of in a tough situation this past year because of high inflation. Mm-hmm. So the Fed is looking at, okay, well, we're seeing some economic turbulence, but also inflation's really high, and they're sort of stuck between two options. Well, I could cut rates to try to help bolster the economy, mm-hmm. or I could raise rates to fight inflation. Raising rates to fight inflation is just exactly the opposite. You want to make people feel less like they want to go borrow money and buy things because you want the prices of things to stop accelerating so quickly. So, typically, when interest rates go down, bonds go up. Mm-hmm. Because let's say that you had a bond that was paying 5% interest, and then all of a sudden interest rates went down to 2%. All of a sudden your bond that you own that pays you 5% interest looks really attractive relative to what everybody else can get. So you could sell it to everybody else at a premium. So that's kind of what's going on, is really the inflation dynamics have forced the Fed to raise rates into potential economic slowing versus cutting them.
Yeah. And real quickly before we go to the next slide, the same, or maybe the opposite is true of the environment for bonds right now, being that since interest rates have gone up, if we owned that bond that was 2% and now it's paying 5%, well, what we can do is we can get into that bond that's paying 5% and have a bigger future fixed income payment, but my face value, my paper loss of my bond still doesn't look or feel that good at this point. But the nature of the investment is such that my future fixed income payments will be greater, especially in the type of bond funds that we're invested in with thousands of different bonds in them. So.
Absolutely. And to that point, so there's a nerdy word called duration that I won't even get into, but basically, yeah, if you, if you're buying bonds that maybe are, let's say on average across our portfolios, maybe about 5 years out. Well, as long as you're drawing money, longer than 5 years from now, you're actually better off by interest rates going up. It seems weird because the value of the bonds in your portfolio will go down, but as those bonds mature, all the new bonds you're going to reinvest in over the next, handful of years are going to be at higher interest rates, and you're going to end up earning more money. Now that depends. If you need all the money, 6 months from now and you have a 5-year bond and interest rates go up, you're not too happy about it because, you're not going to have time to reinvest all those bond proceeds as they mature over your whole investment time horizon. But absolutely, you're right on.
Well, and the last thing, and then we'll move off of this because we're still on the first slide, but is that this is one reason why sometimes it is a good thing to buy individual bonds if you need to match durations or other things that we could maybe save for another time. But in situations like this, it is good to have a bond fund where you have an average duration, where you have bonds maturing all the time, so you can go buy new bonds at higher interest rates, things like that. So it's one reason why bond funds are great. Also knowing that sometimes individual bonds make sense for investors, but this is a good reason for bond funds.
Absolutely.
Okay, that's it on that.
Yeah, so that's kind of the broad overview of the market. This next screen you're going to see is just the U.S. stock market. And a couple of things I'll note here. One is, U.S. stocks make up about 60% of the value of the global stock market. And so, as a lot of you probably know or assume, the U.S. stock market is really, really big. A lot of the biggest companies in the world that do business in all kinds of other countries are listed here in the U.S. So that's kind of the big show. It's the main stock market in the world. It's where most portfolios are allocated a majority to the U.S. because of that reason. You look within the U.S. this year, we can characterize investments different ways. If the company's big or if it's small, if it has a relatively high price relative to the value of its assets, which we call a growth company, or a low price relative to the value of the assets. And generally over the last year, large companies did a little bit better than small companies. But growth companies did a lot worse than value companies.
Yeah, it's interesting, and really just to hit on your comment of the U.S. being 60%, I always like to look at that with clients and tell them, hey, we do love the U.S. We're not investing most of your money in the U.S. only because we love the U.S. It's also by far the biggest portion of the world market cap. But maybe just expand on the small value versus the large growth. Small value was down, about 14.5%, a little less, and large growth was down 29.14%. And past months we've seen large growth outperform value, and we know that these things aren't always staying true, but maybe it would be worth to dig into that just a little bit.
Yeah, absolutely. So, at different points in time, these different types of assets are going to perform differently. It's definitely not the case that we would ever expect one category to always beat another category over every measurable time period. In general, if you look at really, really long periods of history in the U.S. stock market, at least, smaller companies and value companies have tended to outperform over really long time periods, large growth. But it really depends on the environment. And there's all kinds of things impacting all these individual companies in the stock market and what's going on. But, interest rates may be a big part of this too. You think about a company that is, priced really high relative to the value of its assets now. Well, it might have a really high price because investors are expecting really great things in the future, right? And when money is cheap and that company can borrow to, fund all this growth in the future at, 1% interest, 2% interest, well, that seems like a really, really reasonable business plan. But once borrowing money gets a lot more expensive, investors start sharpening their pencils and asking companies like, hey, where are the profits now though? Like, we really want to see some of your big growth plans come to fruition. Obviously tons more going on in the market than that, but it's not unusual to say, okay, when interest rates have risen way more than we expected, that some of these kind of high flying growth names that all their opportunities were further out in the future, that they might come in a little bit relative to smaller and value companies.
Yeah, that's a great point. I do think, a lot of times, which is true often, that a small value company may experience more volatility than a well-established large company, but sometimes that's not actually true. Large growth can have more of a dip than small value. So as you said, it differs. But
and just to just to give some examples here, like large growth, like Apple is a name that would be large growth. Tesla would be maybe the classic name. A long time ago, Tesla would have been a small growth company. Small value companies are probably companies that you don't hear a lot about in the headlines. Maybe a local utility or something like that. Usually, like more boring names are going to be the small value ones because they're not incredibly high priced, popular, high flying, and they're not huge national brands either.
Yep, that's good. I don't have anything else on that one.
Perfect. So on international, international did better than the U.S. And a lot of times we get this question from clients: is like, why are we invested internationally? And a lot of times clients, might have opinions too of, hey, I feel more confident in the U.S. market than other international markets. But a question you always have to ask is at what price? And so, generally international companies are actually a little bit cheaper than U.S. companies. And for whatever reason, that combination of companies internationally has performed a little bit better. Now we're still talking about being down on the year, but it has outperformed the U.S. this year. That's part of the reason why, not that we predicted that international this specific year is going to be better, but it's nice to have a diversification outside of the U.S. for the times when U.S. does worse than other markets.
Yeah, even though international is down, it is good to see, especially since international has underperformed the U.S. here in the past 5 or so years. Yeah, it is good to see. Again, it was still negative, which we would much prefer it be positive, but it is good to see the diversification benefit be there. So absolutely.
And then we'll jump on to emerging markets. So this is basically, it's international, but sort of we put them in a different bucket because their markets aren't quite as developed. And so like examples here might be like Saudi Arabia would be an emerging market, whereas Germany would be a international market.
Sure.
So emerging market stocks similar to the US this year. They're a much smaller part of the pie of the overall market, on the globe, but similar performance to US.
Interesting to see value consistently be down less than growth in this market. Just an interesting trend that's all there.
So jumping to the next one, we've got actually on the screen here returns by country, and you can see the global average there is down, just shy of 20%. You can see the U.S. is down just slightly more than the global average, but this one's always interesting to me to look year by year because this is why we avoid trying to pick portfolios based on past returns. You might be looking at this screen and thinking, why are we not invested, in Turkey? It was on over 100% return this year, and I can't guarantee future performance or anything like that, but I could say that investing, your entire portfolio in Turkish equities because they did well last year would not be advice that we would condone, and that's why we want to spread out, because we want some exposure to Turkey, right, for when it has a crazy year like this, but we, if it goes down 40% or 80% next year for no particularly good reason, we don't want to be totally exposed there.
And by the same token, it's always fun to ask the question, of course, hindsight being 2020, but if I asked you January 1 of 2022, do you want all your money to be invested in, you have to choose, do you want 100% of your money to be invested in Turkey or the UK or the US, whatever? I think I know what you're going to choose. You're probably not going to choose Turkey, but like you said, this is why this shows the diversification benefit. It shows why we're not chasing past performance. And I always think that little quilt chart of where over the year, where has each country or each market shown up, and it's really hard to find any type of pattern. So buy it all. And buy it as it represents itself. At least that's a good place to start.
Absolutely. So jumping to this next screen, we'll talk about fixed income. There's a lot of stuff going on here. Probably more details than I would think most clients would probably want to dive into. But what this really shows is that interest rates have gone up a lot, and I'll actually focus your attention on that kind of graph right in the middle that shows some lines. And it shows 1 year, 5 year, 10 year, and 30 year. So that's what's called, to get real nerdy, the yield curve. And it's basically, what interest rate are U.S. government bonds paying at different maturities. And so that bottom line that shows, what were government bonds paying as of 12/31/2021, you can see that a 1 year bond was paying nothing, close to 0% interest. A 5 year bond was maybe at 1%. and then you go all the way out to 30 years, that bond was paying maybe 2%. You can see now, a year later, we're in a very different environment. 1-year bonds are paying over 4%. 10 years are around 4%, and 30 years are around that mark too, or at least they were at the end of the year. So no matter how long you're borrowing money, rates have gone up quite a bit over the last year. And again, that goes back to our earlier conversation of Fed's trying to raise rates to have people borrow less, so they'll buy less stuff, and inflation will not go up as quickly.
So this has multiple different effects on clients, or we can even just say people. And obviously, what some folks feel if they're in the market of buying a home is, okay, now my rate's gone up and I'm gonna have to pay somebody else more money to borrow. But the opposite is also true, right? For clients or people with cash sitting in savings accounts that's making 0.08%, knowing that there is access to investments that are very high quality, low risk, that are paying more than zero. Because in 2021, if we had a client or we had somebody that we were working with that had a bunch of cash sitting in a savings account, all we could offer was maybe a little bit better. But now, right, if you even just go buy a very short term treasury bond, you can make 4 or 5%. Right?
Yeah, absolutely. And that really gets back to thinking from it ground up of at the basic level of the whole point of the Fed raising and lowering interest rates is, sometimes they want people to save their money and not spend it when they want to slow the economy down. When they want to speed it up, they want people to not save and go spend it. And so they shift that balance between being good for savers or being good for borrowers. And right now it's definitely shifting towards being better for savers and worse for borrowers.
That's good. Great. That's it for me on that slide.
Yeah, I guess the only thing I'd say is, obviously this is as of the end of December. When we're recording this, most indices you look at are probably up on the year. The U.S. has been up maybe 5%, international, 8-ish, and bonds in the U.S. A couple percent. So, doing these market updates, we always like to pick nice round periods to end it. But markets are always moving. They're moving. Not as we speak because markets closed about 30 minutes ago, but every day markets are moving, and so
absolutely. Just really to wrap that, really our intention is to give you some context on what happened in 2022. And as you said, we do have to wait a couple weeks for that data to become available. So, nothing further from me other than just that. That should be a good summation, and maybe close the book on 2022 and get into 2023. And let's hope this trend continues of the markets moving the right way.
Yeah, absolutely.
Awesome. Well, now we're going to jump into a little bit of hopefully what you've been waiting for. Is Social Security going broke? And on the screen here we have just that. And when we say, is Social Security going broke, Adam will take us a little deeper in the weeds than I'm going to go here. But there's a couple questions we can be asking. Number one, what is Social Security, right? And when they're reporting that Social Security is going broke on the news, what are they actually talking about? I walked into my mother's house the other day. Sorry, Mom, if you watch this. And she's telling me, they just told me on the news that Social Security is going broke and that I might lose my benefit or something to that effect. And so maybe at least we'll have one viewer of this. But let's jump right in. And maybe first we just talk about, is Social Security going broke? If yes, what does that mean? How can we have some effect on it? How can we control it? And what does that mean? Is it the Social Security Trust Fund or is it Social Security as a whole?
Absolutely, yeah. And so trust fund is the key word. There is, you can think of the Social Security Trust Fund as sort of like the government's piggy bank. If you work a job, you probably noticed before payroll taxes come out of that check, and most of that is Social Security payroll taxes. Your employer would also be contributing the same amount to Social Security. So about 12.4% of your gross pay split between you and your employer goes towards Social Security every year, right? Yep. And for the longest time, the amount that was going into the Social Security program was actually more than was coming out of it, because we had, the baby boomers generation, lots of people in the workforce, more people working than there were retiring. And so, to your point, that trust fund, they set that up to say, hey, we have more coming in for these benefits than we're paying out, and we got to stick it somewhere. So we'll put it in this Social Security trust fund. And what has happened recently is the trust fund has actually started to become depleted because recently it flipped from less money coming in and more money going out. Now they'd saved up a bunch of that piggy bank throughout history to be able to sort of fund that over time, but yeah, we did start to get to the point where the Social Security Trust Fund was being depleted over time. And you can actually see that on this screen. OASI stands for Old Age and Survivors Insurance. So that's the Social Security you're thinking about. DI is a disability fund. But yeah, that red line on the screen is sort of the Social Security Trust Fund. And when they talk about it going broke, you can see that red line kind of headed for 0% sometime around 2035, just before that.
So if we do absolutely nothing, we being the government, the United States as a whole maybe, if we do absolutely nothing, it's true, we've debunked the myth, Social Security Trust Fund is going broke.
Yes.
Okay, so with that, now we jump into, do we think that will actually happen?
Yeah.
And go ahead.
I'm gonna be my typical picky self of based on current projections, because there is some stuff in there. If people start living way longer, all of a sudden that'll make it go broke even faster. People live less long, it'll sadly make it more solvent. If people retire earlier, later, more people are born, turn to the workforce, blah blah blah. But yes, that is the projection.
Based on current projections, it will go broke around 2034. It is quite interesting to think about everything that can affect that.
Yeah.
Even just COVID and all that craziness that we've experienced the past few years. But with taking some of that out, it's at least reasonable to think that that trust fund will go broke. So with that, really the question becomes, and if you want to jump back and talk any more about the trust fund, feel free. But for now, I'll go into the question. Really becomes now is what do we do about that, or what can we do about that? And I think one of the biggest things that comes to mind for me, again, I'll kick it back to you to go whichever way you want to go with this. But there are things that we can do about that to make that trust fund and to make Social Security last a lot longer. It's not like doomsday for all Social Security spenders and people that are on, especially those that rely on the Social Security benefit. Those are the ones you really worry about, or at least I do. But it's not like total doomsday. It doesn't mean that to save Social Security, do we need to end all benefits, right? I think what we have here is that if we even reduce all benefits by about 20% and we were only paying 80% of benefits, and that's the only thing we did, that would make the trust fund last quite a bit longer. So, just to be very clear, the first thing we could do, the U.S. could do, is lower all benefits by about 20%, and that gives us a much better future projection for that trust fund. So, just thoughts, Adam. Take that wherever you want to.
Yeah, absolutely. And that's actually, if nothing is done, I think that is probably what would kind of automatically happen is 2034 rolls around, there's nothing left in the Social Security Trust Fund, so all they have is the incoming payroll taxes to fund the benefits. And that's where that 80% comes from is, that's how much they would actually have. So if they just looked at everybody and said, this is all we have, it's only 80% of what we said we'd give you, and they gave it all out, that's what would happen. And that would continue, for 100 years. So, almost 100 years. So it would become, instead of a program with like a trust fund with a guaranteed benefit, it would become a program that whatever we get in payroll taxes, we're going to divide up and send out.
Just turns right over.
And I'm not predicting that will happen, to be clear, but that is like the simplest idea of what happens when the trust fund runs out is, benefits could get cut.
That's a fascinating way to state that, is that, okay, 2034, we have no money in the trust fund, so all we're living off of is what other people are paying in. And that would fund about 80% of current benefits. And then from there, the question becomes, okay, what are future benefits and how do we fund that? But yeah, really fascinating. And I think the biggest takeaway for me is that it doesn't, even if the trust fund went broke, or let's accept that the trust fund goes broke for this example, we can still fund 80% benefits just by doing one thing.
Yep.
On the next slide, I'll let you, kind of dig into this one, but there are a couple other things that we can do as well.
Absolutely, yeah. So if you looked at it from the other point of view and you said, okay, I want to pay everyone everything I promised to pay them, how much more would I have to charge current working people in payroll taxes to have enough money coming in the door now that the trust fund's done to be able to pay those benefits I promised? Right now between the employee and the employer, payroll taxes are about 12.4%. If we just rode this thing white knuckled until 2034, trust fund ran out, payroll taxes would have to go from 12.4% to 15.6%. So the employee side of the payroll taxes would go up about 1.5%, and the employer would go up 1.5%. So again, if the U.S. government decided we want to totally keep our commitment on the payment side, and all they did was change the tax rate, they would raise it about 1.5% on both sides.
No one likes paying more tax, but again, not an astronomical number. 1.5% for employee, 1.5% for employer, and this is just another lever we can pull to continue Social Security benefits, and it could be one of, or it could be more than one lever that we use, right?
Absolutely.
That's good. Anything else on that?
No, I think this one's my favorite one because it's really nerdy. There's actually a tool online that you'll see on the screen you can go to, and you can put in all the kinds of crazy assumptions you want about what laws could change to save Social Security. And I put these on here not because I'm predicting these will happen, but just to give you an idea of, if I had to guess what would happen, they're going to come up with all kinds of different ways.
Yes.
To try to, they're going to do a little bit of taxes. They're probably going to do a little bit of changing benefits. This one, just to roll through, this would keep Social Security funded for the next, 60, 70 years. If they reduced initial benefits by 5%, they increased payroll taxes by 1.6%, so 0.8% on the employee, 0.8% on the employer. They raised the retirement age from 67 to 68. They changed the nature of the CPI adjustment to be something called a chain index, which is really nerdy, but it's a little bit lower than the normal CPI adjustment. They covered newly hired state and federal employees, and the reason that would help is because they're new employees, they're probably younger employees, so they'll be paying in before they take out. And they could apply the payroll tax to cafeteria plans, which are kind of certain forms of compensation and benefits that some employees can receive that aren't currently subject to it. I'm not advocating for those changes, but just making the point that there's a lot of different ways this could get handled by a bunch of little tiny tweaks that all seem small, but together add up to a lot. And there's been times in the past where Social Security has been on a path to run out of money, and changes as boring as these have been made to save it.
Yeah. So I think this would be a fun. We'll put this link maybe in the email when we send this out to clients, just in case they wanted to go and play around on that little tool there. But to your point, I think the biggest takeaway from this slide, and then we'll kind of get into what Castlepoint thinks and run some projections maybe. But biggest point here is that number one, is the trust fund going to go broke? Yes, but there's things we can do about it. What can we do about it? I hadn't thought about raising the retirement age. That would make a profound effect, right? Even if you only did it by 1 year. We could do that. We could raise taxes and again, we're not advocating for any of this, but just by 1.5%. Or if we did absolutely nothing, which I also don't think is the case, we could still fund 80% of benefits just by the current taxes being paid in.
Yep.
So super helpful. Yeah, we'll put that. Like I said, we'll put that link in the email there, so you can go play with it too if you'd like. Anything else there, Adam? Okay. So just to kind of wrap that up a little bit, and we'll may get into a little bit of projections, or take this any other way we want to. But just to do a quick wrap up, we have on the screen here is Social Security going broke. A lot of what I just said is on this slide, but just to reiterate one more time, there are a lot of steps the government can take to make sure that this in fact doesn't happen, that Social Security doesn't go broke. And not to get macro on this topic, but if you think about how many people really rely on Social Security in our nation, it's probably not likely that they're just going to let this thing go completely broke. So as you said, and as we've been saying, it's likely that they're going to do something about it. So Okay, so now if we accept that Social Security is not going to go completely kaput, if we know that there is going to be some benefit, even if it was 80% of it, or if it was 100% of it, what is that benefit worth to folks? And we talk a lot to clients about this is a substantial benefit. So why don't you take us through and talk about just how much this could mean to a family?
Absolutely. So I'm going to use a couple of quick assumptions here. I'm going to look at the benefit for just one person based on the maximum benefit in 2023, which would be about $43,000 a year at normal retirement age. If you're, age 65, the average life expectancy there for males is about 18 years, females about 21. So call it 20 years on average if we were trying to put a mathematical calculation together for the population. On average, that's kind of the numbers that we would use.
Yep.
And so this next slide shows what's called a Monte Carlo simulation. And if you're a client with us, you've probably seen a kind of a fancier version of this we use internally. The benefit of this one is it's free to use online, and so we can cite our source there, and you can go check it out if you want to, and that really long link you see on the screen. But basically, I said, okay, well, if I wanted to be able to withdraw about $43,000 a year for 20 years and not run out of money, how much money would I need in stocks? Mm-hmm. And the second question you have to ask there is, well, what percentage likelihood of success do you want based on historical information, right? Because stocks go up, sometimes they go down over longer time horizons. Returns tend to level out. But basically, this simulation said, hey, if you want about a 50-50 shot based on historical returns to be able to withdraw about $43,000 a year, you need about $450,000 in stocks to do that. So if we value it that way, then the maximum Social Security benefit is worth at least $450,000.
To get a 50% chance of not running out of money by spending $43,000 a year.
Yep, that'd be kind of the stock equivalent, yeah.
Yep, okay, good.
And so I guess my point there would be, I think we can probably say that Social Security has a better than 50-50 shot of still being around because it's based on payroll taxes, at least to that 80% level that we tried to establish earlier. So yeah, kind of on this next slide, we changed the assumptions a little bit. So we said, what if you want to live longer than 20 years? It'd be kind of a bummer if, you plan to live 20 years exactly and bad news. You're healthier than the average American and you lived a couple years longer and, now you have to eat cat food or whatever. I don't know what the joke example there is. So this scenario said, okay, well, what if you want to have a little safety margin in there? You want this money to last 25 years. And what if you want kind of a 3 out of 4 chance that this money is still around? That's what that green line shows. Then you need about $700,000 to replace Social Security with stocks.
Based on that life expectancy, that longer life expectancy, and a little bit better chance of not running out of money.
Yeah.
Well, and we're not doctors. I always like to say that, but people are living longer and longer, so it seems reasonable to expect a little longer life expectancy than our parents and grandparents, right?
Yeah.
So, interesting.
Absolutely. And this last one is just the real conservative approach. So it's saying hey, if I wanted to save enough in stocks to be really, really sure, 9 out of 10 chance I wouldn't run out of money for 30 years, how much would I need in stocks to be able to generate that $43,000? And that's about $1 million in stocks to do that. And so, if you think about Social Security as being at least that 80% threshold being pretty secure because it's secured by payroll taxes. It lasts as long as you live, so you don't have to worry about outliving it. It's adjusted to inflation. That's a big deal over time. So if inflation ends up being higher than you think it will be, that's okay because it rolls right into Social Security.
Just like this past year.
Absolutely.
Right? I think we had the biggest adjustment in quite a long time this past year.
A huge adjustment in Social Security.
Yeah. So yeah, absolutely. That's a great point. That I always like to talk about the inflation adjustment. But a couple other things maybe is that number one, Social Security it's a fixed income payment, so it can allow you if you're depending on how you manage your assets and not to get too far into asset allocation things of that nature. But if we at least know that it is a substantial benefit, we can allocate our money a little differently on the stock and bond side. Don't need to go into that, but just at least putting some type of value on it. And how you value it is, again, it's based on your life expectancy. It's based on a number of things. But if we can at least know that for us, what we're using a single person making 43, right? And if you're married, if two people, if one family has, you know, a man and a wife that are both taking the max benefit, these numbers elevate, right? I think that's worth noting. But even just putting a value on that can be helpful for somebody, because it's easier to comprehend a total amount than it is to say, oh yeah, I'll be making $3,000 a month. Okay, but that adds up over a period of 20 years, right?
Absolutely. And, you know, in that example, that was the max benefit at normal retirement age. Yeah. But, you know, as we know, if you delay Social Security, every year you delay it, they actually pay you a larger monthly benefit. And, you know, not to give broad financial advice, but a lot of the time that ends up being a really good idea. Yeah. To delay it, you know, based on your portfolio and your total situation.
Absolutely. Well, I know we're right at about time, Adam, and just to wrap up, I'll give a brief summary of what we talked about, let you fill in any holes, but glad today that we walked through the 2022 market review with you. Adam talked us through the U.S., international, emerging markets, what happened in all the different markets that we invest in. Then we got in a little bit to, is Social Security going broke? And if it is, what can we do about it? We established that the trust fund is going broke if we do nothing, but there are a number of things that we as the U.S. or the U.S. government can do about that. Talked about those. Again, we'll leave a link in the email for you to go play around with that if you'd like. And then finally, we established, okay, what is Social Security actually worth? And for somebody that's taking, even just one person taking that max benefit, it can be worth around $500,000 to $1 million, depending on how long they live. So for me, this was a great webinar. I'm wrapped up. Adam, any holes to fill there? Anything else you want to leave with?
I think that pretty much covers it. Just yeah, we're always happy to talk more about individual situations, but you know, Social Security, it's a important part of most people's retirement you know, picture. Even
a bigger part than I think a lot of people realize. Great point there on the continued conversation. I'd also say, if you want to discuss, you know, should I delay or should I take it early? That's definitely a case by case. Let's get you with your financial advisor and discuss that decision. But hey, really appreciate everyone joined us today, and looking forward to seeing everybody again soon. And here's to a great 2023.